Hi class, this is our second and last video for chapter 5, and I want to get a couple of concepts over to you. So my first question to you is, we're going to do a little quiz. Which of these is FIFO and which of these is LIFO? Okay, a little graphic representation here. One's first in, first out. One's last in, first out. And, okay, accounting humor. Well, you can figure out what the last in, first out, the first thing you ate, or the last thing you ate is the first thing coming back, or the last thing you ate is going to flow on through. So first in, first out, last in, first out. Hopefully this will help you remember. Let's keep going on and talk about a few more things in this class and in the concepts associated with inventory. So we're looking, we talked about FOB before, FOB shipping point, FOB destination. I gave you the example in the South China Sea of a bunch of SUVs that are underwater that were from Kia that were shipped. So FOB shipping point, goods included in the buyer's inventory, and FOB destination, goods included at the buyer's inventory after arrival only. During transit, FOB destination, the inventory belongs to the shipper, to the seller. So at destination, once it gets there, it becomes the buyer's. Shipping point, once it leaves the sellers, it becomes inventory to the buyer. So be clear, the flow, and very important, just because the inventory is not there doesn't mean you're not going to count it. All right, consignment goods. You've probably seen consignment shops. They have clothes, they have loaner clothes almost. They don't own the clothes, they don't own the items. Even a lot of car shops do that. They say, oh, Dr. Scott, we'll sell your car for you. I don't have to transfer the title. It's still in my name. I'll just leave it there because I'm busy during the day. I'm teaching, I'm doing whatever. And they are going to go ahead and take care of showing the car. And all they want is a low price, a 20% commission or 10% commission or 50% commission, depending on the goods. Consignment goods are typically 50%. So they take care of the stuff for you. They take care of selling and you pay them a commission. But the consignment goods never belong to the consignee, the place you're consigning it to. They belong to you, the consignor. There's damaged goods, obsolete. If they're in the inventory, they need to be reduced in value. If they're obsolete or damaged, they're not worth what you probably originally paid for and tried to sell them for. So something called NRV, or net realizable value, sales price minus the selling costs. And if something breaks, you got to record a loss. If Walmart drops that gallon of milk into the aisle, that is a lost gallon that's never going to get sold. So that's going to be a write-off. That's going to be taken in as a loss. And then we have to determine inventory costs. In inventory costs, we take, if you bought let's say Best Buy bought a $500 TV for $400, and then they got a 210 net 30 terms discount. So they get off of 402%, that's $8. So they got to take that off the cost of the inventory. And then they have to add the shipping. They have to add other costs associated with the inventory to make it the true inventory value reflecting all costs. And then internal control, taking physical count. Sometimes there is rotations on the counts called cycle counts. We have a convenience store or any type of gas station store. At night, it's pretty quiet, so they might count 2 shelves worth, and then the next night, whoever's on duty counts another 2 shelves, and they rotate it. But at the end of the year, and usually at the end of the month, they usually take a full physical all at once of everything on the shelf. So the pre-numbered inventory tickets, counters have no inventory responsibility, so they're not going to hide stuff. Set it aside. Counters confirm existence amount. I'll tell you, when I was in public accounting, I loved inventories. Not because it was usually between Christmas and New Year's, because it was an interesting time of the year, but because you could really see what a business does. Inventory is powerful. It's the business of what they operate and how they make things and do things. And by looking at their inventory, you can understand their business a great deal. And then we talked about FIFO, LIFO, and yes, the cartoon you saw in front. And you saw this slide in my last video and the methods. Let's go through a couple of the way these assumptions work. So FIFO, LIFO, weighted average, probably a little neater. I did it on the spreadsheet. Just to point out, this is a flow assumption. It is no guarantee of the last item you bought is the first item you sold. It's just an economic assumption. When you go down to Walmart or Food Line or the Piggly Wiggly, do you go in and say, let me check on the shelf and look at the newest milk? I want the freshest stuff. Cheese, yogurt, dairy stuff, eggs. I do it most of the time. I want to get the latest and greatest. But how does Food Lion and Walmart want to sell? They want to sell last in, first out. So the last stuff coming in, no, did I say that right? They want to sell first in, first out. So the stuff that came in January 5th, then January 10th, January 15th, they want to sell January 5th first. If they did LIFO, they'd have this January 5th all the way at the back, and then by the time March came around, they still have some January 5th stuff. They're not going to want to do that. They want to do a FIFO, first in, first out. But likely, they actually maintain their inventory on a LIFO basis, last in, first out. So economic versus reality, no relation. It's even more vivid if you say, well, let's go look at the gas station and say, how are they selling gas? And you say, well, let's do LIFO. Well, how do you identify which gallon gets sold? You can't. It's all mixed together. It's all jumbled together. Just a cost flow assumption. So by now you should understand, hopefully, the LIFO, FIFO, weighted average, how they fit and how they flow. Okay? And we've looked at this formula before, and I'm going to flash this screen at you as well. Remember the T accounts here, inventory showing up here, cost of goods sold showing up in the income statement there. But this is what I wanted to get to. Beginning inventory plus purchases equals cost of goods available for sale. Take away cost of goods sold, you have ending inventory. Take away ending inventory, you have cost of goods sold. But you notice cost of goods sold and ending inventory better equal the total goods available for sale. Just by formula. That's how that works. That's how that operates. And then costing under perpetual. We haven't talked much about that. But again, physical flow doesn't need to follow cost. But a perpetual system, we're going to bracket it as we go. So there's another terminology of, is the cost flow assumption balance sheet oriented or income statement oriented? And if it's balance sheet oriented, it means the inventory is more accurate cost-wise. If it is considered, if it's income statement focused, it is with the cost of goods sold being more accurate. So a LIFO would give, if periods are rising costs, so prices are rising, what's going to happen? You're going to sell the most expensive stuff first. Chances are the next time you buy something, it's going to be even more expensive if everything was increasing in price. So the income statement is going to be most accurate for cost of goods sold being more accurate by selling the more costly stuff. First in, first out would sell this stuff. On the other hand, the inventory on a LIFO basis, if you sell the last stuff that you got, you're left with the first stuff. And that's less accurate. So FIFO is more accurate for pricing of inventory on your balance sheet. So it's a little bit different. And weighted average does a smoothing and kind of it always falls in between the two. So here's our sales, cost of goods sold under FIFO, under LIFO. And then we have gross profit, operating expenses, income before taxes, tax expense at 30%. As I said, the max is 21% currently in the US, but they're probably including state taxes too, which is usually 5 to 10%. Net income, and then we have our inventory on the balance sheet, the value of the asset called inventory. And they're all different numbers depending on the method you use. So LIFO, FIFO, weighted average. IRS requires that when you use LIFO for tax reporting, you must use it for financial reporting. So you can't use LIFO on the books and LIFO for the IRS and use FIFO on the books. If you're going to use LIFO, you've got to use it both ways. As a note, IFRS, we talked about GAAP, US GAAP. The international financial reporting standards do not allow LIFO as an inventory method. US GAAP does allow it though to be used. Okay, lower of cost to market, LCM, is required to report inventory. So if you buy something, let's say you buy wine at 10 bucks a bottle and you sell it for 25 bucks a bottle. It's sitting on the shelf for 10 years and it's turned to vinegar. Well, what's the market value of what cost you $10? Probably $2 for a bottle of vinegar. So you need to value it at the lower of cost or market. You pay 10 bucks, it's only worth $2. Market's going to be $2. And there's some techniques for determining what that market price is. We have to take the sell price, we have to allow for selling costs and some valuation there. Okay, both inventory turnover, day sales. Let's talk about inventory turnover. And I'm going to just take a quick look at inventory turnover formula. So we have a formula for inventory turnover. And we'll go ahead and draw. We've got inventory turns. How many times is your inventory turnover in a year? We've got two numbers we look at, cost of goods sold and average inventory. I'll ask you a question. Which of these is bigger, inventory or cost of goods sold? Well, in theory, inventory goes up, goes down, goes up, goes down, but cost of goods sold keeps going up and up and up and up. Every time we sell something, you add to cost of goods sold. You buy something, you don't touch it. You sell it, you add some more to cost of goods sold. So the bigger number in this mess is going to be cost of goods sold. The smaller number is going to be inventory, but we need to take average inventory. Why is that? Again, cost of goods sold is for the year, an income statement item. Whenever we combine an income statement item with a balance sheet item, we need to take an average of the balance sheet item. So if I told you I had $100 million in cost of goods sold, and I had $10 million in average inventory, maybe 10, 11 at the beginning of the year, 9 at the end of the year, that comes out to 10 times or 10 turns. What are 10 turns? Well, on an average in a 365-day year, that's every 36 and a half days. That is telling me we sell our inventory 10 times a year. Every 36 and a half days, on average, 100% of our inventory is sold. Now, that means some is sold in 20 days, some is sold in 50 days, some isn't sold all year, and some is sold in 10 minutes. But on average, 36 and a half days. So I want to get the point across of what we're doing in, let's see here. Inventory turnover and day sales. Day sales is a formula which we'll get to momentarily. So let's walk back and understand that we're calculating. Typically, you want faster inventory turnover, but again, it can be too fast. So same way I've told you before, typically you want enough cash on hand to do what you got to do, but you can have too much cash. So inventory management, we walked through purchase and sales, Costco and Walmart, cost of goods sold. They're calculating their inventory turnover 11 and a half, 12 times a year. On average, 32 days in inventory. So that's a month's worth of inventory at about 12 times a year. And for Walmart, they're a little faster. Costco might be having, Costco is faster in turning inventory 12 times a year, where Walmart's only turning it over 8 times a year. So it's slower to move at Walmart. It's been improving from 1 year ago to current year. And it was improving here. So usually a faster turnover again is usually better, but that's kind of how the flow goes. Let's walk through the methods here. Beginning, purchase, sales, purchase, sales. We're going to total all the purchases, total all the sales, and we're going to do a month-end analysis. But notice we bought 55 total units. We sold 43 total units. Our total cost of acquisition was about $6,000. And the ending unit inventory was 55 minus 43. We've got 12 units left. We sold 43. We have 12 sitting in inventory for a total of 55 units. This is tough, actually. If you don't practice it, it takes a little bit to sink into LIFO, FIFO, and calculate. But that's the big picture on how we want to calculate things, how we want to see things, and how we want to understand things. You got a bunch of exercises in the homework, and I'm available if you have further questions or want to talk. Thank you for your time, and I look forward to your continued participation. Thank you so much.